Welcome, future wealth builders. Investing, whether in stocks, a rental property, or a small business like a cafe, is your ticket to financial freedom, but it's easy to stumble when you're starting out. I've been there, diving into a rental property deal and eyeing a franchise without a plan, only to learn the hard way. Today, we're covering 15 investing mistakes beginners must avoid to help you invest smarter, whether in financial markets or physical businesses like real estate or a retail shop. This video blends examples from stocks, real estate, franchises, and small businesses to show you the pitfalls and how to dodge them. We'll keep it practical. So grab a pen and let's dive into mistake number 1. Mistake number 1, not having a clear goal. Investing without a clear goal is like opening a gym without a business plan. Are you saving for retirement, a rental property, or franchise? Why it's a problem? No goal leads to mismatched investments. A friend bought a retail space for quick cash but needed liquidity for a wedding. How to avoid it? Write down your goal and timeline. Saving for a house in 5 years? Consider a duplex. Retirement in 20 years? Try stocks or a stable business like a laundromat. Action step. Define one goal, like buy a $200,000 rental property in 7 years. Mistake number 2, chasing hot tips and trends. Chasing hot tips, like a trendy stock or a hot franchise like a poke bowl shop, is a rookie mistake. Why it's a problem? Hype fades fast. Many lost money on 2021 meme stocks, and a colleague's smoothie bar failed when the trend died. How to avoid it? Research thoroughly. Check a stock's financials or a franchise's local demand and startup costs, e.g., $100,000 for a Subway. Action step. Before investing, research for 30 minutes. For businesses, visit similar local ventures. For stocks, use Yahoo Finance. Mistake number 3, ignoring fees and costs. Ignoring fees hurts, whether it's stock trading commissions or real estate maintenance costs. Why it's a problem? A 1% fund fee can cost thousands over years. A rental property's unbudgeted repairs, e.g., $5,000 yearly, can erase profits. How to avoid it? Choose low-cost ETFs, under 0.2% fees, or budget 15% of rental income for upkeep. For franchises, factor in royalty fees, e.g., 6% for Dunkin'. Action step. Check fund fees or estimate business/property costs. Switch to low-cost options if fees exceed 1%. Mistake number 4, putting all eggs in one basket. Not diversifying, betting everything on one stock or a single bakery, is risky. Why it a problem? If a stock crashes or your restaurant fails, you're wiped out. In 2008, overinvesting in one property type crushed many. How to avoid it? Spread investments across stocks, rentals, and businesses. Own multiple properties or mix a franchise with an ETF. Action step. If over 20% of your money is in one asset, e.g., a single rental, add a fund or side business like an online store. Mistake number 5, trying to time the market. Trying to time the market or a business launch, like waiting for a perfect moment to buy stocks or open a gym, is futile. Why it's a problem? Missing the best market days cuts returns. Delaying a coffee shop launch might miss peak demand. How to avoid it? Invest regularly in stocks via dollar cost averaging. Launch a business when your plan is ready, not perfect. Action step. Auto-invest $25 per month in an ETF or set a business launch date, e.g., Q3 2026 for a retail shop. Mistake number 6, letting emotions drive decisions. Letting emotions guide you. Panic selling stocks or closing a struggling Airbnb can derail your plan. Why it's a problem? Selling stocks during a 2020 crash missed a rebound. A friend shut down his food truck too soon, missing a tourism boom. How to avoid it? Write a plan with rules for selling stocks or exiting a business. Wait 24 hours before emotional moves. Action step. Draft a one-page plan with goals and exit rules for your portfolio or business. Mistake number 7, overlooking risk tolerance. Ignoring your risk tolerance, how much uncertainty you can handle, sets you up for stress. Why the problem? High-risk stocks or a startup cafe might thrill some but panic others. A friend sold a volatile rental at a loss. How to avoid it? Assess your comfort. Try a risk tolerance quiz. Prefer stability? Choose bonds or a stable franchise like UPS Store. Action step. Take a Vanguard risk quiz. Align investments, like picking a duplex over a fixer-upper if risk-averse. Mistake number 8. Neglecting research. Skipping research, whether for stocks or a laundromat, is like buying a car without a test drive. Why the problem? A friend bought a retail space without checking zoning, facing leasing issues. Unresearched stocks can tank. How to avoid it? Study stock financials on Morningstar or local real estate trends on Zillow. For businesses, analyze competitors and costs. Action step. Spend 30 minutes researching your next investment. Visit local businesses or check a stock's revenue growth. Mistake number 9. Focusing on short-term gains. Chasing quick wins, like flipping houses or day trading, often backfires. Why it's a problem? Flipping a property can lose money if repairs balloon. Short-term stock trading racks up fees. Businesses need years to grow. How to avoid it? Focus on long-term growth, rental income, ETFs, or a stable business like a daycare. Action step. Check investments quarterly. For businesses, set long-term goals like $5,000 monthly revenue in year 3. Mistake number 10. Borrowing to invest. Borrowing to invest, like a loan for stocks or a second mortgage for franchise, is dangerous. Why the problem? If a stock or business fails, you owe the debt plus interest. A colleague's borrowed gym venture collapsed under low sales. How to avoid it? Invest only surplus cash. Pay off high-interest debt first. Start businesses small, like a part-time food cart. Action step. Pay off debt above 6% before investing. Use a budgeting app to track cash flow. Mistake number 11. Ignoring tax implications. Ignoring taxes on stocks, rentals, or business sales can shock you. Why the problem? Selling a property or stock triggers capital gains taxes, up to 37% for short-term. A friend faced a $15,000 tax bill after selling a duplex. How to avoid it? Use IRAs for stocks or 1031 exchanges for real estate. Consult a tax pro for business sales. Action step. Explore tax advantage accounts like Roth IRAs. Track holding periods to minimize taxes. Mistake number 12. Not starting early enough. Delaying investing, whether in stocks or a small business, costs you dearly. Why it's a problem? Starting at $25 with $5,000 per year at 7% grows to $1.1 million by 65. At 35, it's $500,000. Early rentals appreciate more. How to avoid it? Start small now. $25 per month in an ETF or saving for a property/business. Action step. Open a brokerage account or save $25 per month for a rental or side hustle like an Etsy shop. Mistake number 13. Overtrading or overmanaging. Overtrading stocks or micromanaging a business, e.g., tweaking the store's menu daily, wastes money. Why it's a problem? Trading fees and taxes hurt returns. Constantly changing a cafe's layout confuses customers. How to avoid it? Buy and hold stocks or rentals. Follow a franchise's proven model like McDonald's. Action step. Limit trades or business changes to align with your plan. Wait 48 hours before acting. Mistake number 14. Not rebalancing your portfolio. Not rebalancing, whether stocks or properties, skews your risk. Why it's a problem? If rentals dominate your portfolio, a local market crash hurts. Stocks can also overweight your risk. How to avoid it? Rebalance annually. Sell overperforming assets, e.g. a high-value property, and buy others like bonds or new business. Action step. Check your portfolio. If one asset, e.g. a single rental, exceeds 20%, rebalance with a fund or new property. Mistake number 15. Not seeking professional advice. Going alone without expert advice can cost you. Why it's a problem? A friend bought a retail space without a lawyer, hitting zoning issues. Complex stock portfolios need guidance. How to avoid it? Consult a fee-only CFP for investments or a business advisor for startups. Use SBA resources for businesses. Action step. Schedule a consultation with a CFP or SBA mentor. Verify credentials online. That's it. 15 mistakes to avoid in stocks, real estate, or businesses. Set goals, research, diversify, and stay disciplined. Whether you're buying an ETF, a duplex, or a franchise, small steps now lead to big wins. Start with $25 in a fund or save for a food cart. Time is your superpower. Challenge. Pick one action step today, like researching a rental market or drafting a business plan. I started with a tiny stock investment and a side hustle. Years later, both are growing. You don't need millions, just consistency. Share this with a friend and drop questions below. Here's to building wealth, one smart move at a time.